Why is the sky blue? Why is grass green? Why do we drive in a parkway but park in a driveway?
That's got me thinking, man, what is the meaning of life?
All great questions, none of which will be answered in today's show. We are going to be answering questions only about loans to give you the information that you need to build your portfolio better. Welcome to Mortgage Monday. I'm David Green, host of the BiggerPockets Real Estate Podcast, here with my partner and broker in the One Brokerage, Christian Batchelder. Let's get into it. All right, we have asked you to leave your comments on YouTube for these Mortgage Monday shows, and you have listened. In today's show, we're going to be answering questions that came directly out of the YouTube comments that the BiggerPockets world wants to know. So first off, thank you for listening. Second off, thank you for leaving these comments. And third off, make sure you leave comments on today's show that just may be answered on a future show. So Christian, let's jump into this. Question number 1. Somebody wants to get a DSCR loan to buy, and then they want to transfer that to a conventional or an FHA loan later. First off, can this be done? And second off, in what circumstances would this make sense to do?
Very, very interesting question. I mean, I would be curious to talk to this individual to see what his current situation is and what his goal is, because I'm not sure this would get you there. The quick answer is yes. There's technically nothing stopping you from doing that. But if you qualified for a conventional loan, you should have gotten that before the DSCR loan. The conventional loan is a lower rate, better terms, lower closing cost. The DSCR loan is the next best option when you don't qualify conventionally. Now, maybe you got a raise at work and you do qualify conventionally now. Sure, there's nothing stopping you from refinancing a higher interest rate DSCR into a conventional. That's a situation to answer the second part of a time it may make sense. But remember, DSCR loans often come with prepays as well, right? So that's something that you want to extend past your prepay before you refinance. So yeah, nothing should stop you. It would just be a rare situation you'd see it in.
Good point. Okay, so if I hear you correctly, it's probably not wise to use a DSCR loan if you would qualify for a conventional loan because the rates are going to be better on conventional and you usually won't have a prepayment penalty. But if the only way you could get into the property at the time was a DSCR loan, it could make sense to refinance later since conventional loans typically have lower rates. And again, this is assuming the interest rates have stayed the same, because if they've gone up, even though conventional rates are lower, they might have gone up to the point that even the lower conventional rate can be higher than the current DSCR rate that you have. And as a side note, remember, most DSCR loans do have a prepayment penalty. So if you refinance into something conventional, you may have to spend extra money to do that, which might make it not worth it. So to sum that up, go with conventional in the beginning, if at all possible. And since most real estate agents don't understand the difference between a VA loan, an FHA loan, or a conventional loan, you want to find a good one. My advice, check out BiggerPockets.com/agent match, where we at BiggerPockets can put you in touch with the real estate agent in your area. All right, second question. Are there pre-approvals for DSCR loans? How do you see this product in a market where homes are only on the market for a day or two? I think what they're asking is, does a seller look at a DSCR loan like it's less valuable than a conventional loan?
Oh, this is such a good question, and one that if I was your lender, I would be calling that listing agent and making sure they understood, because there is a way to announce a DSCR loan as actually a strength of your file. Number one, there's no income verification with DSCR. It is a business purpose loan. You're buying a cash flowing business. So what we're looking for, to pivot this on to the first part of the question as well, there is a pre-approval. The pre-approval would be verifying that, you're a borrowing entity, that you're either in an LLC or a, citizen or whatever the case is. Number two, that you have the assets. So that's requirements of down payments and reserves showing in a bank account, which you typically be providing as proof of fund to your realtor anyways. So we need that. And number three, typically we like to see what type of asset are you targeting? Is it something that's going to qualify us to cash flow? Right? If you go and tell us, I'm looking, we work in Northern California a lot, David. So if Kyle, who's your head of your NorCal real estate team, for all those listening, come to us and say, David, we're targeting a duplex in Sacramento. We're expecting $2,500 a month from each side. We know, hey, that's $5,000 total in rent. We can qualify you for a mortgage up to a $5,000 monthly payment to buy that house. That would help us predetermine the purchase price, which would go on your pre-approval. Okay, absolutely. So to answer your question, there are pre-approvals. And to, once again, finalize with the last part of this question, how are these programs competitive? It's the same thing as getting a conventionally financed offer, except if it's discussed, it may even be better, because you don't have to worry about the borrower's income. You don't have to worry about them getting fired. You don't have to worry about all the crazy Fannie Mae and Freddie Mac guidelines that go into qualifying a conventional loan, or FHA, that's even worse for that matter. This is, our borrower has the funds and we already have estimated what the property cash flows for. We know we can close this loan. This is an investor-based loan and therefore less conditions than what you're normally used to. We feel confident we can close this loan, right? So when markets are sitting on property a day or two, DSCR offers are very competitive if they're discussed correctly.
Good point. Overall rule when you're trying to buy a house, the loan doesn't matter as much as people think. The reason that FHA and VA loans themselves specifically have gotten a bad rap is because VA loans have requirements where the buyer is not allowed to make certain repairs. The seller has to make them in order for the loan to close. So things like dry rot will sometimes pop up on a VA loan, and the buyer is not allowed to make the repairs. The seller has to make them. So if you're a seller, you're not going to like a VA loan in case that happens. Similar stuff for FHA loans. They're also, for whatever reason, they're known for having lower appraisals than conventional loans. And I don't know how accurate this is in today's market, but a lot of sellers, or really a lot of listing agents that are advising their sellers, they like to steer away from FHA and VA loans because they're afraid of a low appraisal. The last thing is, if you're using FHA or VA, you likely have a smaller down payment. So if anything pops up, there's a roof problem, the HVAC is old, those buyers are statistically more likely to get cold feet because they just don't have enough cash. Whereas a conventional loan at 20% down, it doesn't mean that the actual loan is better, but it might mean that the buyer is likely to have more money. So they're less likely to back out of the deal. I think this is where some of these stereotypes have come from, but DSCR loans require 20 or 25% down. So you don't have that low down payment problem. And it's not like they're harder to fund. They don't put more requirements on the deal. So don't worry about that when you're using a DSCR loan. Just make sure that your loan officer and your real estate agent explain to the listing agent that this is a product that's really good so that the listing agent doesn't have any erroneous ideas. All right, third question. Is it okay if some down payment or reserves are money borrowed from a personal loan? So I think what the person is saying here is, hey, if I don't have the money for a down payment and I borrow the money from someone else, but I pay it back as a personal loan, is this allowed by the lender?
This is a tricky one because technically there is a question on your loan application. Many of you guys who have filled out loan applications, you know there's that little section with all the disclosures. I'm not currently in bankruptcy. I'm not currently, a felon in a felony. There's a few questions that are just like the check boxes that go into a loan application that you don't really spend a lot of time on. One of those questions that people very often miss is any or all of your down payment borrowed. So there's a question on a loan application for that. It can be okay to get a personal loan to close. It just needs to be disclosed and the loan program needs to allow for it. Now, where people get in trouble is they don't disclose it. And then they go to underwriting and they have told us they have the funds. Now, we check bank statements, but assuming the lender didn't check that they had the funds, and you go into escrow and, oh no, I don't actually have the funds. I'm going to get them wired from my neighbor. Oh, is your neighbor giving you a gift? No, my neighbor's giving me a loan. Ooh, well, we don't have you in a loan product that allows for that. And the way that we estimate that is we actually add that liability onto your debts. So if we qualified you without that, now you're taking on a new loan, you actually increased your debt to income ratio. And in some cases, that may push you over the threshold. So like all things, communication is important with your loan officer. If that's the situation you're in, let them know. They can potentially pivot to a product or a situation that would allow for it. But ultimately, the best way to do it is, can you get a gift? Right? Gift funds are typically acceptable, which is where you just get a gift from a loving parent or a family member, whatever the case is, who wants to help you invest in the property, and that's the agreement, right? Limited ability as long as it's disclosed correctly.
Yeah, the reason would just be if you're borrowing money for a down payment, that's extra debt that you're taking on. So the lender wants to use that when they're calculating it into your debt to income ratio. But again, a lot of the time, the problems that people run into is that they're trying to avoid PMI, or they don't have cash and they want to buy an investment property that requires 20% down or 25% down, whereas house hacking options require so much less money down. Which is why frequently the advice I give is like, look, to use a primary residence loan gets you a better interest rate. It has better or lower lending requirements in most cases, and you get a lower down payment option. What it costs you is comfortability. So if you're willing to give up your comfort, you can save a lot of money, rent a place out, make it a house hack, and then in a year you move out of it, or even less if something doesn't work out with the home, you can't make it work. Turn that into a rental property and you can avoid some of these issues of having no money or having to bring in a partner or having to borrow money. All right, next question. Are there other escrow waivers lower than 20% down?
I really like this question. This is a great one because this is such a classic example of disinformation that has bled through the industry because, once again, a single lender doesn't offer something. So somebody goes into their bank and Chase or Wells Fargo do 5% down conventional loans, and they have told the borrowers that you have to have impound accounts. So just to clarify, everybody, your impound or your escrow account is the taxes and insurance portion of your PITI, right? Your mortgage payment. Your only requirement to actually pay to the lender is your principal and interest. They collect the taxes and insurance to make sure those are paid. There's an option to waive that section from being included in your mortgage payment, so you only pay principal and interest to the lender, and then you just pay your insurance policy once a year when it's due, and you go pay your property taxes once or twice a year when it's due. Some counties are once a year, some counties are twice. And you can just pay that on your own, so you don't have to have it deducted from your monthly payment. It's a misconception that that's only available when you put 20% down. That is not true. We can waive escrow payments on 5% down loans, right? We can waive escrow payments on almost our full array of loan products, depending on the lender. So because you heard something from Chase or Wells Fargo does not mean that is truth written in stone and across the industry, okay? If you guys are interested in waiving an escrow payment below 20%, it's very possible the loan product we have you in does not allow that. If that's a concern, make sure you let us know up front so we can pair you up with a lender that allows that, just like anything else.
All right. And our last question, can you recast a loan at any time once you reach 20% equity, or is it only during the first 30 days after you purchase?
No, recasting. So this comes from our old episode, I'm assuming, one of our first episodes of Mortgage Monday where we did recasting. Recasting is not like an official loan service. It's not like a refinance. Recasting can only be done after a bulk payment. So it's not a timeline. It's not anything. If you make, usually most lenders set it at 10% of your loan balance or more, a big, large bulk payment that you pay to principal, that's above and beyond what your minimum payment is, right? So if your minimum payment is $2,000 a month and 10% of your loan is $100,000, you would need to pay $105,000 a month. You need to pay a big bulk chunk. Right. The moment you do that, most servicers will allow you to do what's called a recast. That'll be where they'll say, since you just contributed so much to your principal, you've now kind of messed up your amortization timeline. So they take what you have remaining in your loan and they re-amortize it after that big payment over the remaining of the time. Okay. And it can drop your payment. It can reset your principal and interest balances. There's some benefits that it could bring to you. If that's something that you're planning on doing, reach out to your servicer and say, what are some projections that I could expect, assuming I pay $100,000 bulk into my down payment? And it's not necessarily like first 6 months, first 2 months, first 60 days. At any point in time in your 30-year holding of your loan, you'd be able to make a bulk payment, right? At any point in time.
Where do you think the 30 days idea came from?
So I said 60 days on our video, and I said, oh yeah, if you just do this really early on, because I was talking about a specific strategy. If I could go back and clarify that, the strategy that I was referencing was mentioning shortly after closing, right? So I said, hey, in the first 30, 60 days, go recast your loan. That's not because that's the only timeline it's available. I was just specifically referring to that strategy. Recast is available if you make a bulk payment on your loan.
I got it. So you were giving specific advice about something someone could do. It doesn't mean it's a requirement they have to do it.
Absolutely.
Awesome. All right. Before we get out of here, is there any questions that were not asked here that you think should have been asked that you'd like to answer?
That's a good question. What question would I ask my loan officer, right? And seeing what I see on the behind the curtains, so to speak, of the industry, the common questions are always, what's your rate? What's your terms? What's the down payment? You know, what minimum FICO score can you do? What's your minimum loan amount, right? Those are important. It's obviously important to understand your loan officer. What you guys don't see, you guys being listeners and potential clients, is what goes on behind the scenes. That's, I would ask, like, what's your average underwriting turn time, right? Are you guys running 24 to 48 hours, or do you have like a 5-day review? That means if we have, let me just give an example here. If you have a 14-day loan contingency, that means you have 14 days to get a loan approval. You lose 4 of those days because it's weekends. So a 14-day loan contingency is actually a 10-day loan contingency. Okay. If your underwriting turn times are 5 days, that means we submit docs up front. We don't get an answer back until 5 days later. Then we submit a second round of docs. We don't get an answer back until day 10. Your loan contingency is up. And if you didn't clear all of your conditions in 2 submissions, technically the loan officer failed. Oh, but we got the lowest rate. Okay, well now your deposit's at risk. Like, was that worth it? Probably not, right? Like, if the loan officer understands what lenders not only, provide the best balance of good rates, but can also get this thing done, like, that's equally as important. So yeah, I think asking what their general turn times, maybe their average clear to close time, things like that, super powerful question. It helps you understand a little bit behind the scenes.
Great point. People don't always think about the fact. I think the assumption is, well, you're just going to close the loan in 30 days. days. So they're asking about the lowest rate. But one of the secrets to the industry is that the reason people get low rates is that they keep the cost of doing business very low. Often they do that by outsourcing work to other countries. So you see a lot of processing happening in the Philippines, happening in India. They're on a different time schedule. So even though they can advertise the lowest rate, sometimes clickbait to get you in there, they're going to be much slower getting that loan actually funded. And those are usually people that are coming to us and they're going to say, hey, I'm in trouble. I can't get loan approval in my contingency due, or I was supposed to close 2 days ago and I'm not hearing anything. Can you help me out with this? So make sure you ask the question of what is the service going to be like, not just the rate. All right. Thank you for this, Christian. This is really helpful. If you guys have enjoyed the show, do us a favor, like the video and subscribe to the channel and let us know in the comments what you wish that we would have answered or what you would like to know. We read them and we will put them in a future show. Thanks, everybody. We'll see you on the next Mortgage Monday.